Hi everyone, my name is Dr.K.Karpagambigai, Department of Business Administration, Dr. S.N.S. Rajalakshmi College of Arts and Science. Now we are going to see about the preference shares in investment management. So what do you mean by preference share? It is also known as a preferred stock or a type of equity security that gives holders certain advantage over common shareholders, primarily in terms of dividends and claims on the company's asset in the event of liquidation. While preference shares are a form of ownership in a company, they are considered a hybrid between equity and debt. Key features of preference shares: priority over common shares. First, dividends. Preference shareholders are given priority over common shareholders when it comes to receiving dividends. They receive a fixed dividend before any dividends are paid to common shares. This can be attractive to income seeking investors. Liquidation preparation. In the event of company liquidation, bankruptcy, preference shareholders are paid before common shareholders, though they are still subordinate to debt holders such as bondholders. Fixed dividends. Preference shares usually pay a fixed dividend which is expressed as a percentage of the par value of the shares. These dividends are typically paid quarterly or annually. This is different from common stock, where dividends can vary based on the company's performance. Limited voting rights. Typically, preference shareholders do not have voting rights in the company. Unlike common shareholders, however, in some cases, preference shareholders may get voting rights if dividends are not paid for a certain period. Convertibility. Some preference shares are convertible, meaning they can be converted into a specified number of common shares at the option of the shareholders. This can be advantageous if the company's stock price rises significantly. Cumulative versus non-cumulative. Non-cumulative preference shares. If the company skips dividend payments, the preference shareholders does not have the right to recover those missed dividends in the future. Callable preference shares. Some preference shares are callable, meaning the company has the right to buy back the shares at the predetermined price after a certain date. This can limit the upside potential for investors. Here, types of preference shares. Cumulative preference shares, as mentioned above, any unpaid dividends accumulate and must be paid out before any dividends are paid to common shareholders. Non-cumulative preference shares, dividends do not accumulate if not paid in a particular period, and the shareholders loses the opportunity to receive those dividends in the future. Convertible preference shares. These can be converted into predetermined number of common shares, often at the holder's discretion, usually at a later date. Participating preference shares. In addition to receiving fixed dividends, holders of participating preference shares may also participate in the company's profits beyond the fixed dividend, sharing in any additional profits distributed to common shareholders. This type offers a greater potential for returns. Redeemable preference shares. These shares can be bought back by the company at a set price after a specific date. The company may redeem the shares before the specified date, usually at a premium. Perpetual preference shares. These do not have a maturity date. Preference shareholders receive dividends indefinitely, provide the company in its operation. Advantages of preference shares: stable income, priority in dividends, reduced risk, potential for capital appreciation. These are coming under the advantages. Disadvantages of preference shareholders is nothing but a limited upsides, because only preference shares do not participate in the growth of the company. Next one, lack of voting rights. Here there is no voting rights. Dividend not guaranteed. So here there is no dividend should be given. Call risk. So the call risk is applicable for only preference shares. Then market risk. So like an equity investment, preferred shares are subject to market risk, meaning their value can fluctuate based on the factors like interest rate, company performance and general economic conditions. Thank you.